Now we're going to talk about a multi-step versus single-step income statement. In a single-step income statement, we take revenues minus expenses to get to net income. In a multi-step income statement, we've added a gross profit calculation. So we have sales less our sales discounts, sales returns and allowances, and cost of goods sold gives us our gross profit. We take gross profit from minus expenses gives us our income from operations. Then we have non-operating activities computations. We'll not be talking about non-operating activities during Principles of Accounting. That is an intermediate accounting activity where you add on to your income statement. So we'll stop at income from operations being our net income. On a classified balance sheet, merchandise inventory is a current asset. Remember, we list our assets in range of liquidity. So cash and accounts receivable are the most liquid, merchandise inventory being the next. These are all things we hope to turn into cash at some point, where our supplies and our prepaid insurance would be much more difficult to turn back into cash after we've already expended the money for them. Then we talk about the acid test ratio. This is also called the quick ratio. What the acid test ratio looks at is what is our ability to cover our current liabilities with our quick assets. The quick assets are the things that we are already cash or can be cash very quickly. So short-term investments and receivables, which we expect to turn into cash very quickly. We hope that our quick assets or cash short-term investments and receivables are higher than our current liabilities. This means that we have the amount of cash necessary to pay our upcoming bills. If that value is less than 1, this can indicate cash flow issues, that we don't have enough cash available to pay our future upcoming liabilities. Here we look at the acid test ratio for Nike over a 3-year period. So we have an acid test ratio, which is the quick assets, cash, short-term investments, and receivables divided by current liabilities. Our acid test ratio is above 1, which is where we want it. We can see it in comparison with Under Armour's acid test ratio. Nike's is higher. Nike has more cash available to pay current liabilities than Under Armour does. Current ratio is total current assets divided by current liabilities. So this includes all of our inventory and supplies in addition to those things that are cash or will be cash soon. We also want that number to be over 1 because we want to know that we have more assets available to pay our liabilities than we have liabilities. If our liabilities are higher than our current assets, then we usually have cash flow problems. Another ratio that we look at in this chapter is gross margin ratio. So gross margin ratio is net sales minus cost of goods sold, which is our gross margin, divided by net sales. This tells us what percentage of our total sales we have available to cover expenses and leave us with a profit. So we see, looking at Nike's information again, they have a gross margin ratio between 44% and 46% over a 3-year period. This means that 44 cents of every dollar that they earned is available to cover expenses and provide them a profit. The next thing we're going to talk about is the net versus the gross method of recording purchases. So when we were going through the journal entries earlier, we were using the gross method of journal entries. So in the gross method, we record the inventory at the amount of the invoice, and then we apply the discount after the payment. In the net method, we record the merchandise inventory and the accounts payable amount with the belief that we're going to get the discount. So it's net of any discount. So if we have a 210 and 30 amount, we're going to record our merchandise inventory right away with that 2% discount. And then in the bottom slide, if we don't make the discount, or the bottom journal entry, the net method perpetual, if we don't pay that in time, then we have an account called discounts lost when we pay it. Okay? So these are just two different ways to record the same exact information. A company is going to either choose the gross method or the net method. They're not going to switch back and forth between different methods. When we sell something, we're also either going to use the gross method or the net method. So in the gross method, that is what we talked about in all of the previous slides, where we recorded the amount of the sale, and then later, if they paid within the discount period, we gave them a sales discount. In the net method, we record that sale net of the discount. So we believe that they're going to not pay the discount. We would then record it as if they were going to pay within the 10-day period. That is the end of chapter 4.